Total consumer debt of 16.5 trillion. Americans are out of control. The economy is spiraling into a recession. What does that mean for the economy? What does it mean for mortgage rates? I'm going to get into that in this video. Stay tuned. All right, Matt, the mortgage guy, residential mortgage broker. We cover most of the United States. To get in contact with my team, go to greatmortgagebroker.com, fill out the form, let us know where you're at and how we can help. In this video, I'm going to talk about the credit crisis, where the economy is headed, and for our purposes here on the Matt, the Mortgage Guy channel, what that means for mortgage interest rates. If you're watching this video before November 28th, I'm going to have This Is John Williams from YouTube talking in depth about what's going on with debt in America, people's credit scores, the massive amounts of debt that people are getting into. In this video, I just want to focus on what's going on in the economy. If we go into recession, what that means for mortgage interest rates. So I was poking around today on the interwebs, and I was listening to some people that I like and trust, talking about credit card balances for the average American. As a mortgage broker, we deal with people's finances very intimately, right? We get to see inside of a lot of folks' finances, a lot of first-time home buyers' finances. So it's no surprise to me that credit card balances continue to increase. Some fun facts for you that, credit card balances, if you look at it on a graph, peaked around March of 2020. They were steadily climbing, right? And I think that number was something like 860 billion in credit card balances. And then we saw a sharp decline through 20 and 21, mostly because stimulus checks, right? People were being dumped money from the sky. So they're able to pay their credit card balances down. So early 2021, that number that had peaked at 860 came down to 740 billion, right? Over the last year, it's been, I think, the fastest increase since 2001 in consumer credit card debt, where now we're back above 900 billion, 920 billion. And the caveat to that is with all these Fed rate increases, credit card rates increase as well. So they've got more debt that's harder to pay. I think we can all agree when your interest rate on your credit card is 22%, it's harder to pay than when it's 18 or 16, right? So the debt is more expensive and there's more of it. Bad thing for the average American consumer. If you look at savings rates, it's the same thing. 3 big spikes during 2020 and 2021. We know what was going on. There was 3 big stimuluses, right? Where the savings rate skyrocketed. Now the saving rate is back down to near record lows that we haven't seen since 2008, something like 3% for the average American savings. So what does all this mean? It means to me that, to keep it very simple, a lot of folks have blinders on, right? And I know from personal experience in mortgage and with helping people with their finances that a lot of folks will spend $9,000 a month when they take home $6,500 and really no plan in place other than we'll figure it out, right? It doesn't end well. It ends in bankruptcy. It ends in repossession of vehicles. It ends in bad things. And all the indicators, if you're, an economics nerd, which I'm not, right? I just keep it simple. And I think that most people who are watching appreciate keeping it simple. But there are indicators that economists look at to say, we're probably headed into a recession, right? A lot of people might tell you that we're in a recession right now. Inverted yield curve is one of those indicators. And all that means is there's different treasury bonds. There's the 1-year treasury. There's the 10-year treasury. There's the 30-year treasury. The 1-month treasury is higher than the 30-year treasury. This doesn't happen a lot. They're saying we're going to pay you a higher yield on a 1-month treasury than we are on a 30-year treasury, that your short-term money is worth more than your long-term. Doesn't happen very often. The last 2 times it happened, August of 2006, August, September of 2019. In both cases, recession came 5 months later. Okay, so if a recession is coming or we're already in one, what does that mean for mortgage interest rates? This is a mortgage channel. Economic activity slows when we enter a recession. We can all agree on that, which brings inflation down. When inflation comes down, rates follow. And that's the whole point of this, is to say all these indicators that we keep looking at keep pointing to interest rates coming down. Anybody who's telling you that rates will be at 10% is probably out of their mind. Maybe I'm out of my mind. December 13th and December 14th are dates that I've continued to tell people to put on the calendar. December 13th is the next CPI, Consumer Price Index, otherwise known as the inflation rate, coming out. It's going to be looking at November inflation. And if that December 13th inflation number comes out lower than expected or continues to show a decrease in inflation, it almost guarantees that we won't see rates go higher, that we won't see rates get back to the highs that we saw in October. For most people, they look at the average 30-year fixed. They go to some place like Mortgage News Daily, and that's good enough for government work, right? Mid sevens we saw in October. We're closer to mid sixes right now. If December 13th inflation continues to decrease, almost guarantees we'll see rates continue to decrease, right? And then December 14th, the very next day, is when the Fed comes out and says, hey, we're raising rates 50 basis points, which we already know is in the cards. More important than that 50 basis point hike is what they talk about for future rate hikes. If they talk about February being another 50 basis points, when a lot of us have already pegged February to be 25 basis points, that could be bad for mortgage rates, right? If they say 25 and then a pause, which is what I think they're going to do, it's a good thing for interest rates. Interest rates will continue to come down. So all of this information about going into a recession, recessions being something that pulls down inflation, inflation coming down being something that pulls down interest rates, are all indicators we're going to see lower interest rates next year. So in closing, how is that going to affect you as a buyer? How's it going to affect you as a seller? How is it going to affect real estate as a whole? Real estate has taken a hit this year. Affordability is a problem for a lot of people. So we haven't seen nearly as much activity, and demand has fallen off a cliff. We'll just call it how it is, right? Demand will come back in the market. There will be a floor set where even if we're 5, 10, 15% off the peak in some of these crazy markets, or 5 or 10% off the peak in other markets, there will be a floor in place because demand will come up and create that floor. People will come back into the housing market as buyers, both investors and owner-occupied buyers, if rates go down 5.75, 5.5, 5.25. I know it to be true because my data that I have for nationwide applications, it decreases significantly once we get to 5.5 or 6% and becomes less affordable. We come back below that, right? Like that's the cost to borrow. That's what people watch when they're buying homes as investments or an owner occupied, right? I think most people would agree monthly payment is the most important, if not one of the top couple things you look at when you're buying a house. So those rates come down, demand comes back. It helps create a floor for real estate. I still think that real estate over the next couple of years is going to be flat price-wise, which is a good thing for buyers. Create some normalcy in the market, but rates will be lower. It'll be more affordable, which is what we need. So your 2 cents below, happy to hear it. Let me know. Again, if you want to connect with me and my team, greatmortgagebroker.com. If you want to connect with an agent anywhere across the U.S., go to homeandmoney.com/Matt. Agree, disagree, like, dislike. I invite it all. Leave your comments down below. Hopefully this was helpful. Talk to you soon. And again, November 28th, this is John Williams, YouTube Live, 3 p.m. Pacific Standard Time. If you're watching this video over the weekend and November 28th hasn't come yet, check us out. See you soon. Bye-bye.